In this video, I will be discussing the effect of technological innovation on profitability and also the impact of technology on the financial institutions' service production. So first of all, technological innovation and profitability. Increasingly important to the profitability and riskiness of modern financial institution has been the technology. So technology includes information and communication systems as well as the software and hardware supporting them. An efficient technology base of a financial institution can result in lower cost by combining labor and capital in a more proficient mix, and also can increase revenue by allowing a wider array of financial services to be produced or innovated and sold to customers. Financial institutions have spent significant sums on technology and related expenditures. For example, spending by Australian financial institutions represented 22.9% of the total Australian ICT market in 2012, estimated at $9.9 billion. By comparison, the total ICT spend by the Australian financial services industry in 2010 was 9.2 billion. So spending by financial institution was the highest of any industry group in Australia in 2012 and nearly 50% higher than the next highest, which is the government sector. Technology is important because well-known technological investments have the potential to increase both in financial institutions' net interest margin. So net interest margin is the difference between interest income and interest expense, and its other net income. Therefore, you understand that technology has impact on profitability. Now, the technology's impact on profitability come from four sources. For example, interest income, interest expense, other income, and also non-interest expenses. Let me give you one example for each. Interest income can increase if the financial institution sells a broader array of financial services due to technological developments. This may include cross-selling financial products by having the computer identify customer needs and then having the financial institutions market financial service products such as life insurance and bank products directly via telemarketing or the internet. Interest expense can be reduced if access to liquid markets for liabilities is directly available through the financial institution's technological capability. For example, the real-time payment system in Australia and the Society for Worldwide Interbank Financial Telecommunication that link domestic and international interbank lending markets are based on interconnecting information systems. Moreover, and financial institutions' ability to originate and securities is increasingly driven by ICT. With regard to other income increases when fees for financial services, especially those from off-balance sheet activities, are linked to the quality of the financial institution's ICT systems. For example, swaps, options, and other complex derivatives are usually traded, tracked, and valued using high-powered computers and complex mathematical algorithms. Financial institutions could not offer innovative derivative products to customers without investment in suitable ICT. Non-interest expense can also be reduced if the collection and storage of customer information, as well as the processing and settlement of numerous financial product transactions, are computer or internet-based rather than paper-based. This is particularly true for retail banking transactions and security-related back office activities. Now we will discuss the impact of technology on financial institution service production, both wholesale service production and retail service production. As we discussed in the previous two slides, that modern ICT has potential to directly impact a modern financial institution's profit-producing capability. Now we provide some specific examples of technology-based products found in modern retail and wholesale financial institutions. First of all, wholesale financial services. The most important area in which technology has impacted wholesale or corporate customer service is the financial institution's ability to provide cash management or working capital services, called transaction services. Cash management service include the services designed to collect, disburse, and transfer funds on a local, regional, national, or international basis, and to provide information about the location and status of those funds. Cash management service needs have largely resulted from corporate recognition that excess cash balance results in a significant opportunity cost due to lost or foregone interest, and corporate need to know their cash and working capital position on a real-time basis. Among the services financial institutions provide to improve the efficiency with which corporate clients manage their financial position, and which have been enhanced through technological innovations are listed in the slide. For example, deposit and liquidity management, receivables management, consolidated reporting, bill pay, wholesale lockbox, funds concentration, electronic fund transfer, check clearing services, treasury management software, electronic data interchange, facilitating business-to-business e-commerce, electronic billing, verifying identities, assisting a small business entries into e-commerce. I'm not explaining each of these items. So those who are pretty interested about any individual services, I suggest that you read the textbook to know about the details. Technological innovation not only have impacted the wholesale service production, it also has impacted the retail production of the services. Retail customers have demanded efficiency and flexibility in their financial transactions. Using only checks or holding cash is now uncommon and usually more expensive and time-consuming than using electronic payments and internet banking. Further, securities trading is undertaken through the use of electronic platforms not tied to any specific location. Electronic trading networks have lowered the cost of securities and derivatives trading and allowed for a better price determination. In addition, electronic trading networks have made securities and derivatives trading more accessible to retail customers. Some of the most important retail payment product innovations include automated teller machines, electronic fund transfer, online banking, pre-authorized debits, telephone banking, email billing, smart cards, smartphone and tablet banking app, and so on. I believe all of you are familiar with these retail services particularly. In recent years, we have seen an improvement in customer satisfaction of the services provided by the four major banks operating in Australia. Much of this improvement in attitudes to the bank has been due to the new relationship interface involving electronic devices. While technology has changed the way customers interact with banks, branch networks may still be important, especially for a smaller depository institution. So that's the end of our discussion in this video. In the next video, I will be talking about the effect of technology on revenues and costs. Thank you very much.